Hi, everyone. Thanks so much for joining us. I'm Jen Rogers, and I am so excited for this breakout because it is really what everyone is talking about right now. It is the election, of course. Nearly 29 million Americans have already voted. Election day itself is less than 2 weeks away, and investors may be wondering if they should be making any moves in anticipation of possible changes in policy. And just to discuss right now is Mona Mahajan. She's Senior Investment Strategist at Edward Jones. And Mona, I have a bunch of questions for you. I'm going to get you in a second, but I want to make sure everybody knows that they can also ask questions. So put it in
Mm.
the chat. We want to know what you're thinking. That'll help make this conversation even better. We also have a poll out there. So please go and answer the poll question. Here it is. Do you feel like you should be making investment moves ahead of the election or based on the election outcome? Yes, maybe, no. Answer that so we know what your thinking is. Mona, let's just get started. And I'm really curious about what the impact traditionally is of presidential elections on stock market performance. What do people need to know?
Yeah, absolutely. It's great to be here, Jen. And you're right, 13 days to go as of this morning. Not only till election day, but we're headed towards the fourth quarter, towards year end, when folks start to think about positioning for 2025 and the year ahead as well. So to your question, what happens around election day and on election years, during election years? Well, a couple of points I'll make there. We ran the analysis back to 1928. What we found is in a typical 4-year election cycle, what we tend to see is actually year 3, which was last year, tends to be the best performing year in a 4-year presidential cycle. The S&P 500, which is a good proxy for the US stock market, tends to return on average about 18%. And keep in mind, last year was a good year in markets. But what's most interesting is year 4, which is this year, tends to be the second best. And this is really regardless of which party wins and who's in office. The second best performing year in a 4-year presidential cycle tends to be year 4, which is the election year itself. And partly that's because some of the uncertainty is lifted after the election is over. Markets can start looking forward again. Investors look towards opportunities. And secondly, what I'll point out is that as we think about this tactically, what actually happens around November 5th itself, what we have seen historically is that volatility tends to pick up in the weeks leading to election day and perhaps even the days leading to election day. The S&P 500 does historically pull back. But what's nice to know for investors is that in the last couple of months of the year after election day, that tends to be typically positive. So the S&P 500 recovers, volatility subsides, regardless of which party wins. So what we'd say broadly is if we do get a little bit of that election-related volatility, it may be an opportunity to lean in, especially if you haven't fully participated in this nice rally in the first kind of 3 quarters of the year. Certainly, we'd think about rebalancing, diversifying, adding quality investments at better prices because we think the fundamentals are intact.
So it actually does seem like a time that you kind of need to pay attention to.
Mm.
If there is opportunity here, what are you saying to clients when you're talking to them and you say, well, there might be some volatility, and they say, well, Mona, well, then should I do something now? Like, what's the answer to that?
Yeah, look, most of our clients and investors, and most investors generally, are long-term investors. They're not investing for the next couple months, not even hopefully for the next couple of years. They have long-term portfolios in place, and they have long-term strategies and financial plans in place. And so the most important thing we want to be thinking about around these election periods where anxiety levels are high, emotions can run high, uncertainty is a bit high as well. We don't want to make emotionally driven decisions on in our investments and in our portfolios, because as we know, missing the best days in the markets tends to have the most outsized impact on your returns in a negative way. And interestingly, some of the best days in markets come alongside some of the worst days in markets. So these are just fundamental theories we want to think about, especially during election periods. Now, what we'd say broadly is what we're seeing in markets and what we'd continue to lean into is we are seeing a broadening of market leadership. So, in the first half of the year and really much of last year, it was all about tech. It's all about your AI names, your mega cap names, your semiconductors, the NVIDIAs of the world. And what we've seen over the last few weeks, really since the start of this quarter, has been a broadening. We've seen interest rate sensitive parts of the market like industrials and financials and utilities and real estate cyclical parts of the market all start to play some catch up here. So we do think this theme of broadening of market leadership has some legs. And really, if we do get that volatility, what we'd be doing is adding to both growth and value parts of your portfolio. Keep in mind, if you're sitting in CDs and cash-like instruments because yields were so high, the Fed is going to continue to cut rates for some time. So those yields and rates may go lower. We want to make sure we have investment grade bonds that can capture some of the higher rates for a longer period of time as well. So what we'd be doing in any election related volatility is making sure we have value and growth in equities and slowly complementing CDs and cash-like instruments with investment grade parts of the bond market.
I want to talk a little bit more about sectors, but also remind everyone, put questions in the chat and also take the poll question. So there are real differences on where the candidates stand on a number of issues. And I think there's some investors that think, oh, I should make some changes based on potential policy leanings. Yeah. So does that ever pan out when people think that they know, okay, this person is going to win and they're going to do that, so therefore I should buy or sell X?
Yeah, that is a great question. And we've actually done a little bit of research on this. And of course, for this election specifically, there are some key policy issues that we're watching that would, we think, impact economics and markets. Those include things like tariffs, taxes, regulation, economic policy. But keep in mind, enacting real policy change takes time. And some of the examples I alluded to earlier, during, for example, the President Trump administration, you might have thought clean energy would underperform traditional oil and gas stocks, given the policy leanings. Well, in fact, during that 4-year period, clean energy outperformed pretty meaningfully by over 40%. And then the reverse happened during the President Biden administration, where clean energy underperformed and traditional energy stocks outperformed. And so what we found there is what drove that performance was not who was in the White House and how they leaned from a policy perspective, but it really came down to what were the earnings trends, where was demand, what was the technology doing, was there an international component coming into the marketplace? And so that fundamental perspective is what drove the investment decision. And we want to keep that in mind because we could, of course, look at policy leanings and make investment decisions, but we could also be very wrong. So in the long run, we think fundamentals are the key drivers. And for markets in particular, it comes down to what are the trends on productivity, innovation, economic growth, and earnings growth. And those are the key pillars that we watch as we think about how and where to invest.
I think it's such an important answer because even when you think you have information that can inform a decision and you think you know the direction it's going to go, it's, no guarantee out there. So I think that's really important to see what we've learned in the past. So you mentioned the Fed, and I do want to get in, just all of this is happening really against the backdrop of finally seeing changes from the Fed. We have a question in here right now about your thoughts on municipal bonds. So incorporating that into what we're seeing in terms of the macro environment, what should people be examining right now?
Yeah, municipal bonds we find pretty interesting here. There is a tax efficiency component to them. So if you're in a higher tax bracket, municipal bonds often make sense because you don't pay parts of federal tax. And also, there's a yield component there. The yields on these bonds have moved higher in recent days alongside a lot of the Treasury bond yields. And so we'd say, especially, if you are thinking about complementing or maybe substituting some of that CD and money market money with traditional bond portfolios, and you are in a tax bracket that makes it more efficient, especially, we think municipal bonds are a great way to make that adjustment. Now, we'd say also from a broader perspective, a lot of infrastructure may be on the horizon for a lot of these state and local governments. These municipal bonds are beneficiaries of that trend as well. So as the budgets are rising for these projects, the municipal bonds become more and more stable here as well. So we are favorable on municipal bonds. And certainly good idea to talk to your financial advisor to make sure that they are the most efficient way for you as well to add them to your portfolio.
And aside from munis, just given the rate environment, you mentioned that we have more moves expected. how, and that you have volatility expected coming in here with the election too, but that it tends to be a good end of the quarter. What does fixed income look like broadly here?
Yeah, it's a great point. And look, this will be an exciting November 5th week because Tuesday is election day, but Thursday is the Fed meeting. So, what a week for investors. We'll be watching Tuesday and Thursday closely. By Friday, hopefully, we'll all know what's going on. But generally speaking, what we'd say is this is a Fed that seems on a path to more gradually cut rates. We're at 5% now in the Fed funds rate. Markets are expecting that to go to 3.5% by the end of 2025. We would say somewhere in that 3.5% to 4% range is where the Fed kind of stops cutting rates. And the reason they're doing that is probably the most important key for markets. So historically, what we've seen is when the Fed is cutting rates and the economy is entering an imminent recession or headed towards a downturn, that's when markets don't perform so well. And if you think back to '08 or even during the pandemic, the Fed had to step in, really cut rates, provide liquidity and support. Markets didn't react very well to that. What we're seeing in this backdrop, what's interesting is the Fed is cutting rates, but because inflation has gradually moved towards their targets for a pretty good reason. They don't want to be so restrictive at 5% when CPI inflation right now is about 2.4%. And the other point to note is we don't see an imminent recession on the horizon in the US. In fact, some of the data points are pointing to a pretty resilient US economy. If you look at the Atlanta Fed GDP now, for example, for this quarter, about 3.4%, so well above 1.5% to 2% kind of historical growth rates, but also well above the zero bound and not anywhere near a downturn. And so this is an environment that we think is positive for the backdrop for investors, for markets, financial markets broadly, Fed cutting rates, economy not heading into a recession. And this really underpins what we call this bull market expansion. Now, we won't continue to go up in a straight line like we've had for much of this year thus far. We will certainly see some bumps along the way. But these bull markets tend not to what we call die or roll over until we get a recession or until the Fed starts raising rates, or if there's an exogenous shock, which is hard to predict. But the first two we certainly don't see. So good backdrop overall, and continuation of the bull market looks likely.
We're getting a lot of activity in the chat, which is great. Thanks to everybody who's taken the poll question. So, in terms of people thinking whether or not they need to make moves here, yes, 21%, maybe 17%, and no, 62%.
Ah,
I don't know if they listened to you at
I
the
was going to
very
say, very smart audience.
beginning, but where they are. I mean, but that's still actually a fair number of people thinking that they are inclined to
Yeah.
possibly make a change. We have a question in here also, just to go further into that. I mean, it is. I think there are a lot, and you touched on this. It's emotional, right? There's a lot going on. We have this really big week. It's crazy. There's an election and the Fed meeting, and what are you thinking in terms of how long this volatility could last? Like, do people need to be prepared for it not just to be, November 5th and we know what's happening, and then it's the Fed and we know what's happening there?
Yeah, it's a great call out because, frankly, we have not really gotten much volatility ahead of this election cycle. I noted we're 13 days out. We've seen a few days this week that did look a little bumpy. We see, yields maybe moving upward in anticipation of the election, but generally speaking, it's been less volatile than what we've seen historically, and that may play out as we even move further along here. But what we'd say is one what we're anticipating is November 5th, we may not have a decision by election night. And I think we've all talked and heard about, some of what might happen. There may be counting issues. There may be some delays in certain states and counties. We're hopeful that by the end of the week, we will have a result. And so during that period of uncertainty, markets don't like uncertainty. There may be a little bit of sideways action, a little bit of volatility, but again, very short term in what we're talking about days here. Now, what we'd be probably more worried about is if after elections, for some reason, we saw fundamental data, the labor market started to look weaker, or on the other hand, inflation started to look much stronger because the economy is actually quite strong. That would create a more fundamental issue that would give either the Fed pause, they might have to move faster, they might have to move slower, depending on what the economic outcome is. And that's really where we'd probably see more bouts of volatility. Election-related volatility, to your point, it may last during that period of election until we have a result. And then it'll be all about, what are the key policies that either candidate is going to pursue first, what is looking most likely to actually happen, and what are the implications around those. Those are TBD, still remain to be seen. But that being said, right now, the most likely path seems to be a Fed that is looking to cut, an economy that is not looking actually too hot or too cold. We call it the Goldilocks economy. And the election day is probably the one unknown that we need to get through.
Looking further out, another fundamental data point. We have a question in here on the correlation, if there is any, between the federal debt and the
Mm,
markets. Is
yeah.
there anything to look at in there?
Yeah, it's a fantastic question because it's one we've been getting quite a bit, actually. We are, of course, seeing in the US federal debt levels rising to really unprecedented levels. I think we're at about 120% federal debt to GDP. What we're concerned about as economists is if the debt rises too fast or too far, we may see a situation where governments are spending too much on paying down interest and not spending enough on productive investments like R&D or infrastructure or even defense spending. And that's an economy where you could see lower growth rates over time, lower potential growth. And we don't want that to be the scenario in the US. We actually see a little bit of that in Japan, where their debt levels are 200% debt to GDP, and they've faced a couple of decades of stagnated growth, actually low inflation, very low immigration rates there as well. But what we're noticing here in the US, despite the very elevated debt levels, the productivity and innovation has been quite strong. If you think about that Magnificent Seven cohort I alluded to, they're all based in the US. We haven't seen much out of AI productivity yet, but that could be coming. But generally, productivity has remained high. Economic growth has remained stable and resilient. We talked about 3% plus potentially GDP growth, which is pretty good versus history. And so we're not yet seeing the impacts to the economy from these elevated levels of debt. Now we're watching it. We call it a yellow flag. We're watching it carefully. We don't want it to get to the point, as I talked about, where we might cross over and it might start having an impact, but not yet a red flag.
We've been talking about the top of the ticket here, right? President. But there's also all these congressional races underway as well. What kind of impact does that have, or how do you need to think about it if you have two different parties, one with the House, one with the Senate, or if one gets both? Like, how much
Yeah.
attention do you need to pay there, and the impact on markets as well?
Yeah, it's a great call out because we actually have been looking at the congressional races a little bit more this time. One of the key takeaways for us is, so a lot of people, it's usually the second headline, not the primary, top of the ticket headline. But many people don't know all 435 seats in the House are up for grabs, and about a third of the Senate will be up for election as well. What we'd say, though, what we're seeing in the races thus far is that the margin of victory, regardless of which party wins in the House and Senate, will be pretty narrow. So, in the Senate, it might be something like 51 to 49 seats, so very, very tight margins here. What does that mean for markets and the economy? Well, it likely means that political gridlock will remain in place. And markets actually prefer an environment of gridlock. It means checks and balances remain on whoever's in that presidential seat. It also means the likelihood of major new legislation or regulation is lower. And so for companies, this gives them better operating transparency overall. And I'd say broadly, some of these more extreme proposals that we're seeing may be checked because we have a Congress that remains divided. So it's an important concept to think about. The presidential race and the congressional race, and markets will be rooting for gridlock going forward.
We just have 1 minute left here. So your takeaway for people, because as I'm looking in the chat, people are like, do you make a move? What if you're retired? I've got, you have a house to sell. People are trying to figure out what to do. And I guess, how important is it to be watching this? Or if you're a long-term investor, what do you do?
Yeah, we'd say this is a great opportunity to start thinking about 2025 and beyond. We want to make sure that you're positioned for not only near-term success, but long-term success. So that means If you're closer to retirement, make sure that you have that balanced portfolio in place. If you're early to the investing game, make sure that you have a little bit more of that risk profile in place, equities in place. And if you're anywhere in between, make sure you have enough cash for your immediate needs, but the rest should be put in the markets for the long term. We continue to see an economy that's working, a Fed that's cutting rates, inflation that's moderating. And yes, we may get some election-related volatility, but that's your opportunity.
Mona Mahajan, it's always so great to talk with you.
Thank
Edward
you.
Jones, Senior Investment Strategist.